So with Nvidia venturing into PC chips and Anthropic filing an IPO, what does it all mean for the overall tech trade? Joining us now is Dan Niles, founder of Niles Investment Management. Dan, it's always a pleasure to speak with you. I first want to get your take, not necessarily specifically on HPE earnings, but the reaction to HPE earnings and the sort of vertical moves that we've been seeing. What's your take? Is this rational?
Well, two things can be true at the same time. You can be in an irrational market, but still have a lot more to go. And so I think that's the way you want to think about things right now, because remember, there's been a lot of bearish calls on semiconductors really starting, I think, March of last year, guys having big put positions. This is all a fraud, et cetera. But you fast forward to January 30th of this year when you had OpenClaw get formalized, right? So agentic AI. And then all of a sudden, token production goes from being up 20% over the prior 2 months to up over 130% in the next 2 months. You're in that next wave of demand. And so are some of these moves, you go, does that really make sense on one day? No. But if you think about the fact that OpenClaw just came out, 4 months ago? It's going to take probably another year for corporations to really embrace this. And so I think you're going to see, upside from here through the end of the year, which is sort of what our call is.
Dan, I guess at some point, given how far a lot of these stocks have moved, the way the companies have been re-rated in terms of their multiple, you almost have to make the call as to whether something structural and long-term is going on here, as opposed to just, hey, a particularly hot part of the typical cycle.
Well, it depends on what you consider overvalued. If you say, well, if a company is growing revenues at 80%, and the PE multiple is 26 times. Is that overvalued? Especially compared to the S&P that's growing revenues at 12% this year, that's trading at about 22 times. Obviously, the company I'm referring to is Nvidia. So I think there are some definite disconnects between what certain stocks like an Nvidia is trading at relative to other names out there, like a Cerebras, where you go, really, 100 times revenues? Does that make sense? But I think in general, that's why stock picking gets, more important going forward. Right. And the bottlenecks keep changing, right? Where CPUs, who cared about CPUs? Then late March, when people started to figure out, and we wrote about this, that all of a sudden the ratios are changing. Now everybody's talking about CPUs.
All right. Dan, we just want to show in Chicago the CBOE closing bell, ending the regular day of trading for options. It sounds like you would be potentially a buyer of some of these bottleneck stocks. Where do you continue to find value, recognizing the fact that even if the moves seem irrational, they might have much more to go?
Well, Nvidia, as I said earlier, that's not irrational. Mm-hmm. That's our biggest position by far. We add more to it.
But how about like an Intel or a Dell? That's how you made your bread and butter way back when.
Intel, we started writing about that in late March, saying they were going to be a huge beneficiary of this move to CPUs. And, today, obviously, it got hit because everybody's concerned about Nvidia. But demand is through the roof because agentic moves from 8 GPUs to 1 CPU. All of a sudden with agentic, you're closer to unity. And that's a huge mathematical change in where the bottleneck sits. Intel's the leader in server CPUs. Will Nvidia gain some share? Of course they will. They have no share today. But does that mean that Intel's going to suffer when they've got the majority of that? No. So it may take a few more days for this to settle out. But at which point then I think, and by the way, with Intel, you have a couple of ways to win. Number two, even if ARM does take off, I think there's a good shot they end up with Apple as a foundry customer before the end of this year. NVIDIA invested $5 billion in them back in September, so let's not forget that. And then you've got the fact that they should be the foundries for some of these hyperscalers. Don't forget they have an announced agreement with Google. Tesla announced working there as well. Mm-hmm. And all of that should help us get a better source of supply in the U.S. for these advanced chips, 90% of which come out of Asia. So I think there's a couple of ways to win with Intel, which is why I like it.
5% so far this quarter. Remember, the market bottomed out in 2026 at the end of March, right when this, the geopolitical tensions kind of picked up. So not surprising we're seeing really solid gains for the equity markets. I thought of note was the Dow and Russell 2000 settled at record highs yesterday. The S&P 500 equal weight settled at a record high close yesterday also. So that broadening out of the rally has kind of lent support maybe for investors and gave them a little bit more optimism here. So heading into, another earnings season in a couple of weeks, we'll probably get some more clarity on those growth rates, because that's been the real lift behind what's going on in the equity market, is that, valuations are stretched a little bit for the S&P 500, but for the most part, earnings have been great over the past few quarters, Diane, and that's kind of supported this risk-on momentum that we've seen in the equity markets. We've got some data this morning also that might roil markets here. We get consumer confidence in that JOLTS report, but also the end of the quarter. Will there be some repositioning going on from investors going into this quarter with equity markets at or near all-time highs? I think that might be a concern here. Maybe some liquidity and depth of markets might be impacted due to the upcoming 4th of July and Friday being closed for markets. So that might add some volatility into markets at this point. But we've seen some stabilization, Diane, in oil prices, just above $70 a barrel. Yields have started to stabilize. That's always a benefit for equity markets, even if they're elevated, right? And there's expectations for a rate hike. If you see that volatility within the debt markets and the yield markets at this point, that also lends an all clear signal, at least in the near term, for equity markets. So yeah, a lot of kind of minutia here and a lot to digest here for investors. But hey, you can't argue with some solid gains for the equity markets in Q2 and the first half of the year.
Yeah, let's talk the tech sector. We got AMD on the receiving end of a price target hike, and I know you want to get into that, but I also want to talk about just where things stand with tech when you think about the first half of the year. SanDisk, the outperformer so far this year. It's all about the chip and infrastructure names. SanDisk, Micron, Western Digital, even Corning have been a part of that, and that's also an AI story. So talk us through, kind of your take on this.
Well, I think if you take a look at the rotation out of maybe the Mag 7, some of the hyperscalers, and pushing into, as you mentioned, some of the memory chip makers, the storage chip makers, Broadcom, and then you throw in the semi-equipment makers, the AMATs, Lam Research, KLAC. Those have picked up the slack for maybe some of the weakness that we've seen in Microsoft and Meta Platforms, Amazon pulling back, Google Alphabet also. So take that into consideration. We've seen solid gains in some of the specialty chip makers, AMD, Intel. I mean, those things have outperformed pretty severely. And then on the flip side, you look at Nvidia, right? Nvidia's underperformed, and the forward PEs on that compared to AMD and compared to Intel, they're getting a little bit ridiculous at this point, in my opinion. Now, the growth trajectory and maybe the law of big size, because Nvidia is the number one market cap out there, maybe that's lending some. But I like the fact that investors are kind of pivoting between the two different sectors and not completely getting out of the market in general. That's going to lend support. But you mentioned AMD. Price target raised to 615 from 505 at Wells Fargo. And, this is just adding on to price target hikes that we've seen for this company. And I think the focus from this analyst is basically on the CPU side. Remember, CPUs were kind of forgotten in 2024, 2025, as all the focus was on GPUs and the market share that Nvidia was taking in that space. Well, Nvidia is starting to dig into that a little bit. I mean, Nvidia still has 90% of the GPU market in advanced chips at this point, but they're making some inroads with the MI350 and the MI450 upcoming also. But yeah, valuations, watch those for AMD and Intel, because they're getting extremely stretched.
Speaking of valuations, Oppenheimer out with a note this morning, but this is across the financials, so let's cross over there. They're downgrading their outlook on, or downgrading their price targets, I should say, on some of these names. Let's walk through this.
Yeah, some solid gains for, the money center banks like Citigroup and Bank of America, JP Morgan so far this year, but now you see Oppenheimer downgrading, and they say they're best in breed. Morgan Stanley and Goldman Sachs, they're best in breed in what they do, and they expect trading revenues to continue to be strong. M&A activity has picked up. That's good for Morgan Stanley. That's good for Goldman Sachs. So let's look at the negatives. Well, they look at valuations. These stocks have had some pretty spectacular runs. it's kind of dicey doing this before earnings season kicks off. We'll get reports in the next 2 or 3 weeks from some of these financial companies, and this could prove to be right or wrong from this Oppenheimer analyst at this point. They did kind of highlight maybe some of the underperformers in there, maybe private equity. You look at moves in KKR, Blackstone, ARES. These have really underperformed. They're down like 20 to 35% so far in 2026. So maybe just recalibrating what they like, maybe taking advantage of undervalued stocks within the financial space. And maybe that's the reason, along with the valuations on the downgrades to Citigroup, Bank of America, Morgan Stanley, and Goldman Sachs here, Diane.
All right, let's shine the spotlight over on Supermicro. It's under the microscope this morning, recovering a little bit of ground, but it lost major ground yesterday on news that its offices abroad were raided. Walk us through the latest here.
Yeah, not surprising. This comes after some raids in May also. Supermicro kind of getting pounded over the last week on this news. Prosecutors targeting 6 individuals with charges focused on document forgery and breach of trust. They did not reveal those identities, and this comes after those arrested 3 people and seized 50 servers in May as a part of their collaboration, the Taiwanese authorities. We all know that the black market for these high-end data centers and servers is probably pretty robust at this point. There was a note out a couple of weeks ago about Nvidia. Jensen Huang kind of pushed back against that narrative that some of their products are getting over into China. But it's probably happening at this point. What does it mean? Supermicro has been struggling, right? Is that a bonus for Dell and HP Enterprises in this space where they're going to be able to take market share at this point? And I think the tamp down from the U.S. government on what they can sell into China, whether they're going into military use at this point. We all know that big Chinese tech companies.
There is something very important happening beneath all of this volatility in Nvidia and the semiconductor market. While investors are debating whether the Nvidia has peaked and whether the memory stocks have to run too far, or whether the AI trade is becoming overcrowded, the companies actually building this infrastructure appear to be dealing with very different problem. They need more capacity. The demand for artificial intelligence computing continue to expand, but the infrastructure required to support that demand is becoming increasingly difficult to secure. And one of the clearest example of this is the memory market. Every advanced AI systems require more enormous amount of memory to operate efficiently. As Nvidia continues shipping more powerful GPUs and AI system, the demand for advanced memory grows alongside it. This has created an unusual situation. The industry isn't currently struggling to find the customers. It's struggling to produce enough supply for those customers. Memory manufacturers have gained tremendous pricing power because available capacity remains tight, and all through the companies are investing billions of dollars to increase the production. Those investments don't immediately solve the problem. New semiconductor factories take years to build, and advanced manufacturing equipment take time to install. Production needs to be qualified. And even after all of that, the companies still need enough advanced packaging and the other component to turn those chips into the complete AI systems. So when investors hear about the Micron, SK Hynix, Samsung or other semiconductor companies expanding capacity, it's important to understand the timeline. More supply is coming, but much of that supply could still be the years away. And that in the meantime, the AI demand continue moving forward. This is the way the NVIDIA story become much bigger than the NVIDIA itself. NVIDIA may design the computing engines power the AI's revolutions, but those engines requires an entire industrial ecosystem around them. They need advanced manufacturing from the companies like TSMC, and they need high bandwidth memories. They need networking, they need advanced packaging, they need data centers, and they need cooling. And first, the most importantly, they need enormous amount of electricity. This is becoming one of the most unappreciated aspects of the AI build-out. The industry can manufacture more GPUs, it can produce more memory, and it can construct more data centers. But none of that matters if those data centers cannot secure enough power. Some of the world's largest investors in data centers infrastructure are now openly discussing electricity availability as one of the biggest constraints for facing the industry. And that tells us something important. The AI infrastructure boom may be entering a new stage. The first bottleneck was GPUs. Then attention shifted toward the high bandwidth memories and then advanced packaging, then networking. Now increasingly the conversation is moving toward electricity and physical infrastructure. Every time the industry solves the one bottleneck, another one will appear. That doesn't look like an industry suffering from a collapse in the demand. It looks like an industry attempting to grow faster than its supply chain can handle. And that's why the capital spending number we're seeing from the largest technology companies are becoming so important. Microsoft, Alphabet, Amazon, Meta, and the other major players are committing extraordinary amount of money to AI infrastructure. But according to some investors directly involved in financing these projects, demand for additional data centers capacity still exceeds what is currently available. That's remarkable when you consider how much money is already being spent. And it raises an important question. If companies are already spending hundreds of billions of dollars and are still struggling to secure enough computing capacity, then how large could this infrastructure cycle eventually become? That's the one reason I think investors need to be careful when assuming that the AI build-out is approaching its end and simply becoming spending enormous spending. Large numbers don't automatically means the peak spending. The more important question is whether the companies are generating enough economic value from the AI to justify the continuing those investments. And that's what upcoming earning reports could help us to understand. Investors will watching hyperscaler extremely closely. They want to know whether the cloud growth is accelerating. They want to know whether the AI are increasing, and also they want to know customers spending. And the most importantly, they want to know whether the capital expenditure plan are moving there higher again. Because if hyperscalers continue increasing their capex, that money flow through the entire AI supply chain. More capital spending means the more data centers, more data centers means more Nvidia systems, and more Nvidia systems require more memory, and more memory requires additional semiconductor manufacturing capacity, and all of that requires more equipment, more cooling, and the more power. This is why the AI ecosystem has become so interconnected, and it's also why the semiconductor stocks have become incredibly sensitive to every headline. Investors understand that the today extraordinary profitability is partially being driven by the supply shortage. That's create enormous opportunities, but it's also create a fear. Because semiconductor investors have been seen this movie before. Demand exploded and supply become constant. Price rises and companies expand the capacity, and eventually too much supply into the market, and that's the traditional semiconductor cycle. The question today is whether the artificial intelligence has fundamentally changed that cycle. I don't think that we can confidently say that the cyclicity has disappeared, but also I don't think we should assume that this cycle will be behave exactly like previous ones. AI demand is structurally different from the consumer driven demand that's historically powered many memory cycles. We are not simply talking about consumer upgrading smartphones or buying the new computers. We are talking about one of the largest companies in the world building computing structure infrastructures that could operate continuously for years. AI labs need compute, cloud providers need compute, enterprises and the government all needs compute. And as AI models become more capable, the amount of computing required could continue increasing.